So in this lesson here, lesson 3, we're going to talk about transaction analysis. And if you want to follow along, grab yourself the note, so-called handout, and make yourself a copy, because that's what we're going to go through. So if you recall, transaction analysis is where we look at how business transactions are going to change the balance sheet. In other words, the accounting equation. If you recall, and I'll do this great big T, the balance sheet is structured like this, where our fundamental accounting equation is the way in which we construct the balance sheet, so that on the left we have assets and on the right we have our liabilities plus our equity, and we total them. That's why we have the balancing line on the same line, because they're supposed to equal each other, because it's an equation. But remember, a balance sheet tells you financial position, but it's a snapshot, a single instant in time. The next transaction that takes place is going to change the values in the balance sheet. So this is learning how those transactions change the balance sheet. So let's take a look at this. There's a note. I'm not going to read through it because I assume you're all literate. So you can read through this note. I'm just going to highlight what's important and do the actual activity. So transaction analysis is essentially if you have a question about this, you fire me an email. But essentially, it boils down to these things right here. Remember this: that you only record financial transactions. In other words, things that can be converted into that have monetary value. Second, because it's an equation, at least two things are going to change. Two balance sheet accounts have got to be affected in some way, or the equation won't balance. Right? After each transaction. So the transactions themselves have to balance, and the whole equation, the totals in each account have to balance when you're done. So grab this link to this spreadsheet and we'll get started. I'll take you through it step by step. And then we got a couple activities in the syllabus that you can try. So first, use this, and all of our activities for transaction analysis will look just like this one, structured the same way. If you look down here, we got 3 tabs. We start with our starting balance sheet, which in this example is for the company Metropolitan Movers. So this is a service business. All of our businesses are going to be service businesses, service sole proprietorships for several months. And this is the end of May. These are the values in the accounts at the end of May. Okay, so the first thing we're going to do is we need to create these accounts on our transaction analysis sheet. So you don't do anything on this page except use the information. The next page is where we're going to do our transaction analysis. And I'm going to zoom out a bit so you can see everything all at once. And this is a high resolution video, so you should be able to see everything. Okay, so it will mark, and our transaction analysis, it'll tell you how you're doing. If the mark doesn't go up, you're doing it wrong. In addition, you may see that a line does not balance as you're working on it, but if the mark's going up, you're still doing it properly. So here's how we do this. We need to enter our opening balances, but first we have to put in our accounts. So the first thing we have to do is, look, we got a cash account, so let's write cash. I'm sure you can figure out how this goes next, right? The next thing we're going to do is we're going to look at accounts receivable. Now, this is one of the few exercises in the course where you'll see an account receivable for each customer. And if that's the case, you order them within accounts receivable, you would order them by alphabetical order by the customer's name. So if they're human names, they're not business names, you go by the last name. So we put in accounts receivable for B Cava. And I think you get the idea. So we're just going to skip ahead. And there we are. Poof, just like that. So there's our accounts. And I will draw your attention to one thing. If you're someone who likes to keep really organized notes, these colors for left side, green for left side, and blue for the right side of the equation, I use them throughout the entire semester to keep things visually clear. So if you want to sort of do something like that, or at least be aware of it, that's what the colors are all about. So next, we have to enter the balances that we started the month of June. You can see these transactions take place during June. So we need to put in the balances we start with, or down here where we total. We're going to end up with the wrong totals at the end because we won't have included the values we started with. So we again have to go from our end of May balance sheet and put in these values. So I would put in 13,500 for cash, etc. You can see right now that the left side does not equal the right side because I've only got 13,500 on the left in the green section, right? The left side of the balance sheet, the assets. And I don't have anything over here. But eventually, once I put all my balances in, if my balance sheet was made properly, the line will equal, right? The line will balance. So left side will equal right side. So I'm just going to skip ahead and do all that now. So there we are. Good for me. Line balances, I'm done. So if we start balanced and we do all our transactions properly, then we will balance at the end as well. So let's do the first transaction. So let's remember our rules. We want to make sure we only record financial transactions, that at least 2 balance sheet items are affected, and after each transaction, the accounting equation is still going to balance. And that's the same thing as saying we started balanced and each transaction is balanced, which means we will end up balanced. It's a mathematical certainty. So let's do the first one. $1,200 cash is paid to Mercury Finance. And it's important to sort of have some perspective, that you're aware of what you're doing and who you are. And we're a moving company. Okay, and Mercury Finance is a financial institution that we have borrowed money from. So if we pay $1,200 to Mercury Finance, what happens? And I always find when students are first learning transactions, this is like key. This is the most important part, because in reality, this is all humans do now, is record the transactions. The computer does everything else in accounting. The entire rest of the accounting cycle is done by computer nowadays. So the only thing a human does is actually record transactions. So this is the most important part of the course. So it helps when you're first learning how to do this to ask yourself, what has changed? What do we have? And specifically, ask yourself, what do I have more of? And what does Metropolitan Movers have less of? Anything? Well, they just paid cash, so they should have less cash. So we're going to subtract $1,200 in cash because that's what was paid. Now, if you watched, my mark went up from 41 to 44% done. So that was correct. This doesn't mean it's wrong. It just means the line currently does not balance. So somewhere I need to get this to balance. So what does Metropolitan Movers have more of and less of? It has less cash. Does it have more or less of anything else? Well, it has to. Question is, what is it? Well, it has less debt because it just paid $1,200 to Mercury Finance. Why would it do that? Just for fun? No, because it's paying off some of its debt. So we have less debt. Debt goes down. That's a minus $1,200 on the right side of the equation, and the line balances. So we're done, right? Was this a financial transaction? Yes. What do I have more? What do I less have? I have less cash. I have less loan. Does the line balance? Yes. 2 things were changed. I'm finished. Next, June 9th, Kay Lincoln, who owns Metropolitan Movers, who owes Metropolitan Movers $2,500, pays $1,100 in partial payment of the debt. This bit, Kay Lincoln, who owes us $2,500, you don't need to know that, right? You should know that Kay Lincoln's a customer. There they are. They owe us money. That's an accounts receivable. There's the $2,500. Well, they're paying us $1,100 at the moment. Okay, so is this a financial transaction? Well, yeah, they're paying us money. So what do I have more of? What do I have less of? Well, I got more cash because they're giving us money, right? We got more dough. So we got more money. Our line doesn't balance. If you looked up here, right, mark went up. So that's correct. But the line doesn't balance. So what do we have more or less of elsewhere? Oh, well, this person owes us less money. So here's an example of both items being on the left side of the equation. So this person named Lincoln owes us $1,100 less money. So line balances, 2 accounts affected, we're finished. June 11th, equipment costing $19.50 purchased for cash. Okay. So if we bought it with cash, what do I have more or less of? Well, I must have less cash. $19.50 less, in fact. Right? So what do I have more of? Well, I bought equipment, so I must have more equipment. The equipment is worth what I paid for it, right? That's the cost principle. That's the gap, the cost principle. So it's $19.50 is what the equipment's worth. So it goes up because I have more of it. That's a financial transaction. At least 2 accounts are affected. The line balances. We're finished. Next. This one, a bit harder. More than 2 accounts will be affected, right? A new pickup truck is purchased at a cost of $18,000. Metropolitan Movers pays 10 grand cash and arranges a loan from Mercury Finance to cover the rest. Okay, let's look at that again. So we're buying a truck. Its cost, so remember the cost and objectivity gap. Cost is $18,000. So what do I have more of? What do I have less of? Well, I have more trucks now. What were they worth? $18,000. Okay. What did I buy it with? What do I have more of? What do I have less of? It's clear this is a financial transaction. So what do we have more or less of? We have more trucks. We did that. And we're paying $10,000 cash. So we have less cash. Okay. Whoops. Missed a zero. So that still isn't balanced. We have negative 10 and positive 18,000. So that's positive 8,000 on the left side of the equation. So it doesn't equal. So what is the rest? Well, we paid 10. What's left to be paid? 8. And well, where's the money coming from? We're borrowing it. So we owe more money. So this debt to Mercury Finance has to go up another $8,000. So financial transaction, at least 2 accounts affected, line balances were finished. Next, Metropolitan Movers completes a storage service for B Cava at a price of $1,500. A bill is sent to Cava to indicate the additional amount that Cava owes. Okay. So what's that? Well, Cava owes us money. That's a customer. So if Cava owes us money, it must be a financial transaction. So that's an increase in what we're waiting to get from Cava. So accounts receivable goes up $1,500. Question is, what else goes up? The cash is not affected. There's no indication of cash changing in this transaction. We certainly don't. We're not owed more money from Lincoln. We don't have more equipment. We don't have more trucks. We didn't pay off any debt. What's left? Well, by process of elimination, it's equity. So we have more equity. But why logically do we have more equity? Well, that requires a bit of explanation. So let's take a moment and talk about that. So the reason this $1,500 increased our equity is because we performed a service. Well, that's what Metropolitan Movers got into business to do, to move stuff for people, right? They're a moving company. And when you perform that service, you earn revenue. That's what revenue is, right? All money from the sale of goods or services that we've earned from the production of goods or services. Well, we produced a service. So this brings us to the question, well, what else changes equity? And the fact is there are 6 things that can change equity. And this you should never forget, because eventually we're actually going to break the equity account apart into all of these different types of accounts. So the first type of thing that increases equity, probably the most common, is revenue, right? Performing a service or selling a good. And its opposite is number 2, an expense, a cost. So money you spend to try and generate that revenue that is consumed in the process. That wealth is consumed, right? So expenses lower equity and revenue increases equity. The next type of thing, I guess we're on number 3, right? The next type of thing is an investment. So when the owner makes a new investment of additional assets, doesn't have to be money, it's usually money, but it doesn't have to be, a new investment by the owner. I'm just going to put new in there. And the opposite of that is not an expense. So it's not recorded as an expense, but it still lowers your equity. It's like when an owner takes money and buys groceries, personal groceries. Because of the business entity gap, you have to remove that value from the business. You can't track it as a business cost. It has to come out. And that's called a drawings. So when the owner draws an asset out for personal use or for whatever reason, and it's not a business reason, it's a drawings. It's a direct charge, a direct reduction to the equity account or accounts. So the 5th thing is basically a windfall. And it's called, in other words, when you sell something for more than it's worth, or money just suddenly appears. It's not a new investment, but somehow you come across it. This is more rare. You'll get it more in grade 12 accounting than in grade 11, but it's still possible. So it's a capital gain. And likewise, when wealth just vaporizes, either because you sold an asset for less than you paid for it, or an asset is destroyed by a fire, and you're not insured, or things like that. So this is just sudden appearance of wealth from a reason other than these first two, and this is the opposite: a sudden disappearance of wealth, destruction of wealth, and it's a capital loss. And those are the reasons, or those are the things that will make equity change. And that's why this $1,500 from performing a service is here under the equity account, because it increases the owner, Jay Hoffner's, capital. Well, this begs the question then, why do we record it, this revenue? So, I mean, obviously it's one of the 6 things that makes it go up, but we didn't get any money yet. So why are we recording it? And now we need to bring in a couple more things that help explain the purpose of accounting, right? What makes it useful? And these often by many people are just referred to generally as gaps. One of them isn't even officially a gap in Canada anymore, but it's still just understood that it's the way you do accounting. So for instance, the first one, this one in particular, is called the revenue recognition principle, or revenue recognition concept. That's what we're just going to call them all gaps for grade 11. It's good enough. Revenue recognition states, and again, if you recall, we need to look up here. Up here at the top of our syllabus, we have references, and this is the one for gaps. And so if you click it, you see this. And we're now going to be right down to here. There's this many gaps that help explain what useful means when we say the purpose of accounting is to provide useful information for decision making. The revenue recognition and the expense or matching principle are the two that we're going to talk about. So the opposite side of revenue recognition is obviously expense, or some often called the matching concept or principle. And this one here states that revenue is recognized when it's earned, not necessarily when cash changes hands. And that all relates to that sort of the 4 points of useful, meaning relevant, right? Because if you've earned money, if you think of a long-term construction project, for example, they're spending money, right? They have expenses that they're spending to build that thing, but they might not get paid all the time. They might get paid in installments, and they might have agreed to get paid when it's done. But it doesn't mean they haven't earned money. So if they just showed the costs and not the revenue, they would paint a very confusing picture. It would show nothing but losses, right? With no money coming in at all. So recognizing revenue when it's earned, and it's the same for you if you have a part-time job and you've worked the last 2 weeks but haven't been paid yet because the paychecks come every 2 weeks or every month. You wouldn't tell somebody you hadn't made any money for 2 weeks, even though you hadn't been paid it, right? You have earned it. You just haven't got it yet. That's what revenue recognition is all about. And really, the matching principle, is the same thing. That both of these are about relevancy. This is just the other side of it. So if you are given a bill or you're using electricity, you haven't paid for it yet, well, you've still used it up in this month trying to generate revenue. So you should be recognizing expenses and trying to match them. That's where the matching comes from. Matching them with revenue that was earned in the period. So the key word here is revenue earned, and expenses, the accounting term is incurred. It's the same idea. So you recognize when you earn both revenue and expenses, and you try and match them in the period when they in fact were earned, not when cash changes hands. So let's look at this one. June 25th. Hofner, the owner, takes out $500 for personal use. Well, business accounts are affected when this happens, right? Because the business has less cash. The owner took it out. I mean, it is the owner's money legally, right? The owner can do that. But it's not a business cost. So we lower our equity, and certainly we have less cash in the business. There's less wealth in the business, so you have to take that money out. And that was 1 0 too many. So the last transaction is a truck requiring it's kind of a repair, right? An engine adjustment, and it's $75. You pick up the truck, you pay for it in cash. So obviously a transaction. We have $75 less cash. Where does it go? So you might think, well, maybe we add it to the value of the truck. And that is a no-no. We didn't buy more trucks. I mean, this can happen if that's not even under truck, but if one of the options is to put it under the truck, then you might think that, but that would be wrong. Anything that keeps an asset doing what it was always meant to do is not an improvement that's added to the value of a truck. So if you bought more trucks, you'd add more here to the truck account, but you're not. You're just repairing the truck, and repairs don't get you any more than what you already had. Still got a truck. So that repair, that wealth, the $75 of wealth is lost. maintaining the truck. It's a type of expense, and expenses make your wealth go down. So now all our rows balance. The only thing left to do is find out our new balances. And so the quickest way is to go equals sum and sum all the values. Don't forget the starting opening balances from May. Add all of those up. And once you've done it once, you can actually do it all the way across. And so now you just prepare the balance sheet with the new ending values. So as it says, these transactions were for June, right? So we're going to prepare the balance sheet for June. And there we go. So you should have balancing values of $61,025. I didn't go through that because I'm sure you can handle it at this point because we've already had a couple of balance sheets for practice. But if you can't get to the end, just fire me an email. So let's try these for practice. We got 3 exercises for transaction analysis, and then we'll try to mark one and see how everybody's doing.